Very good afternoon, good morning. Thank you for attending HYCM's workshop with myself, Giles Coghlan. We will be looking at the major economic data points of the event of the week. And just as folks are signing in, don't forget, as we talk about different entries, exits, the whole idea of this workshop is that it's an educational workshop. I'm going to outline my trading plan for Friday's US ISM data print. It's not trading advice or a signal service, but it's just showing how I go about making trading decisions. I hope everybody's well. Good to see some familiar faces here. Sunith, good to have you. Kingsley, Eddie, Mihal, Setley, Thomas, I think this may be your first attendance, so very warm welcome. And without further ado, I'm going to get into the main event. Now, what we're looking at for Friday is a really crucial meeting. Let me just extend this out to include Friday's data on the calendar. Now on Friday, it's very important to have the background for this because we have to understand whenever we're trading economic data points, there's three things we want to know. One, what's the base case? Two, what will be the surprise? And three, will it change the big picture? So the data point that's going to be particularly of interest is coming on Friday. Let me just make sure I've got Friday's data point. It's the ISM data print for non-manufacturing. Now that is due to come in at 54.5, down from the prior, which was 55.2, if memory serves me right. You can see that was the prior print. Now in the context, this non-manufacturing PMI print was a significant shift higher, particularly when you compare it to the manufacturing PMI data. And if we go back to our calendar, you'll notice that we have ISM manufacturing PMI data from the US today, and is expected to come in at around 48. So now if we just quickly do a quick comparison between the two, you'll see what's going on. So the manufacturing PMIs have been steadily tracking lower. Anything below 50 is when the market's in kind of contractionary territory. And we can see that that contractionary territory is where we're at. And it's expected to be contractionary again today. Now, the element that's been surprising has been the way that the non-manufacturing PMI is so much different to the manufacturing PMI. So in other words, non-manufacturing service sector has been more resilient. Now, some of that is just the differentiation between recovery in manufacturing and non-manufacturing sectors in the US after COVID. So some of that is to do with that. But what the market has been looking at is any signs of the US economy slowing down. Now, manufacturing PMI has been negative, but we've seen a strong labor market and we've seen strong US consumer confidence. So it's been a very, very mixed picture. And if we take a look at the US data throughout the month of February, those of you who've been following these workshops will know that this very strong non-farm payroll print on the first Friday of the month, it came in at 517,000, which is a clear 200,000 above market's maximum expectations, and the prior was revised higher, right? And wages were higher, unemployment lower. It was literally a perfect print. And on top of that, we saw that ISM non-manufacturing PMI come in, do you see? 55.2, far above that 50.4. Now that is what triggered the upside in US 10-year yields and 2-year yields. That's on that same print, that February the 3rd print. That's what triggered the upside in the dollar as investors started to factor in a more aggressive Federal Reserve, right, higher rates. That's why the dollar's been pushing higher. That's why yields have been pushing higher. And that, of course, is why we've been seeing equity markets pushing lower from February down. Aggressive Fed rate expectations means that's less conducive environment for companies and stocks. And we've also been seeing gold pushing lower as well for exactly the same reason. And you take a look at gold and you can see that since that very strong print, markets have been pushing lower. I was long silver on February the 3rd, and I exited my long trade because of that shift that was taking place. And those who follow my seasonal signal trading, my seasonal trading service would have been informed on that. So all of that is what we've been expecting. Now, through it, obviously, one swallow doesn't make a summer, and one sandwich doesn't make a picnic. So this strong non-farm payroll data point that we got on Friday the 3rd was supported by a number of other different prints throughout the month. Inflation expectations, higher, okay? Current conditions, higher. So that was supportive for that outlook. Headline inflation, higher. Core, higher. Notice the month-on-month prints for the inflation CPI of the US was much higher than the prior for the headline, 0.5 versus 0.1 prior. Core in line with the headline, 0.4, but still, stickier inflation. We then saw that with strong US retail sales print, US consumers good. Then we saw the US PPI print coming in, exactly the same as the CPI print. Core higher, and just that month-on-month reading, the month-on-month reading coming in 0.7%, much higher than the market was expecting and higher than the maximum expectations of 0.6%. We then had a series of Fed speakers, all sort of, affirming aggressive Fed hikes, and that generally, hawkish view has been maintained. Labor data supporting the Federal Reserve, and then we had that PCE print. Okay, much hotter, year on year, above markets and maximum expectations, month on month again, above markets maximum expectations. That's a natural headwind for stocks. Now, we didn't see a big sell-off in stocks because a lot of this aggressive pricing has now taken place. It's in the market. And a couple of things to say just to help us. If you look at the interest rate expectations, the interest rate expectations have pushed up now to around 5.5% for a terminal peak from the Federal Reserve in the summer. Now, at the start of the year, short-term interest rate markets had about 4.89%. So in other words, what we've seen is short-term interest rate markets are now moving in line with a more hawkish Fed, and now that's pretty much priced in. Okay, and now for the next interest rate decision, few weeks time, 22nd of March, expecting a 25 basis point hike. That's 79%, and it's 1 in 5 chance of a 50 basis point rate hike. So quite aggressive. That's all priced in. So you can see, let's just turn this down to the daily chart for commodities, and you can see, it's been weighing on silver, weighing on gold. We've now had a little bounce, and the only reason for that bounce is just a little bit of a retracement. Okay, so there's a bit of dollar weakness. Now this has been accelerated overnight because we saw a nice bounce from Chinese data. Now if we just take a look at this, we'll see that Chinese manufacturing came, look, 52.6 above market's maximum expectations of 52. The strongest reading since about April 2012. So a fantastic bounce back from China, which we've been kind of expecting. Now, from the Federal Reserve's perspective, if you have a look at this, there's one thing, this is my HYCM blog. I update this with material every single day. If you're not following me along at the blog, you really, it's really worth following along here. So just see if I can send this to you. Trying to send this in the chat. There we go. No, it's not. Yeah, there we go. All right, I managed to get back through. Now, let me explain to you. This Phillips curve is what's influencing the Federal Reserve. So in other words, what this means in the Fed's eyes is once you see a very low unemployment level. So when people are very employed, which is the situation we have at the moment, high unemployment rate, so not many people are out of work, that leads to higher wages, which leads to higher inflation. When more people are unemployed, that leads to lower wage demand and lower inflation. That's the thinking. Now, this curve is an economic model, right? Sometimes it doesn't look like this, and economic models, they can be helpful as guides, but you shouldn't use it religiously. It's called the Phillips curve, and there's a New Zealand economist who had this basic idea, right? And it's a good way of thinking, essentially. Don't use it, the curve doesn't always look like this. Sometimes it goes out of kilter for various reasons. But basically, this is the thinking that's underpinning the Fed's mind, and so that's why they see strong labor data as inflationary. So we now know, don't we, what is driving the Federal Reserve's thinking. And when it comes to incoming data, what the Fed want to see is slowing labor data. They want to see slowing economic activity. Now, you can see it's taken us a long time to get to that case, but we've got there. And what we're looking for now is the print on Friday falls in this overriding context. And the best opportunity is going to come from a scenario that allows us to see the Fed's mind changed. Now, obviously, one data point isn't going to change their mind, but this was one of the key data points when it came in very high at 55.2 that resulted in some heavy Fed repricing. So if on Friday this comes in at below 52.4, if prices come in 67 or lower, if the employment comes in below 50.1 or lower, and the new orders want to go down, so we want to see this below minimum market's expectations, 52.4 and lower, and if these are in the red, then that should be supportive of stocks, should pressure the dollar, lift euro US dollar, and lift gold. And the thinking is if this is a miss, it will mean that traders and investors will think, the Fed won't need to be so aggressive at hiking interest rates because US economic activity is slowing down. The Fed can be comforted that they're getting close to terminal rate. Now, the reason that supports stocks is because companies will have lower interest rates. That's more disposable income for consumers. That is also a more conducive environment for companies. So all of that is positive for stocks. So in the event of that big miss, I'd expect upside in the S&P 500. Notice this very clear trend line, and I would expect a run up to whatever, I would use a daily PowerPoint, the pivot point on the day. So whatever pivot point we've got, look for a run up to the next obvious pivot point as an obvious target. Ooh. That'll be the way of targeting that. In terms of the dollar, we'd expect the dollar to fall. So you'd expect dollar downside, and I'd expect euro US dollar upside is the way I would trade that. Definitely looking for euro US dollar upside. So that would be just trading that, looking at a daily pivot point, looking for that next obvious target wherever the euro US dollar is when we come to the daily pivot points. And top of euro US dollar upside, I'd also expect some gold upside as well. So with gold, again, just noticing this near-term trend line that's just been broken through. So that is a nice area. This is also a decent support level. So you'd expect a run up higher, potentially to that 1850 region. And if we're already up there on Friday, then we'd look for a run up towards 1870, 1900, speaking to the Bloomberg Ashrak this morning on this. And if we do have a more dovish Fed take, then 1870 to 1900, but it will depend on the data for what's coming in. Okay, so that is the best tradable opportunity that I can see coming up. Now, will that change the bigger picture? In and of itself, it's not going to, but it will form the next part of the picture. So is that a long-term trade? No. If it was a huge miss, then yeah, you could look to hold it over the weekend. If it's just like a big, just a miss, a standard big miss, then I would just look for trading it on the day. Okay, that's how I'll be trading it. The risk to this outlook is that you've then got a series of Fed speakers coming in after the event. We've got Logan, Bostich, and Bowman, Barkin all coming. So watch out for volatility post the event. And obviously, traders and investors are going to be, scanning their comments for signs whether they're going to be more aggressive or less aggressive going forward. That, my friends, is the best tradable opportunity of the week that I can see. And if there's any questions, please do ask away. But that is basically it. Okay, slight aside, we have got ISM print today, and it's the manufacturing data. This is a little bit more trickier to trade because we were expecting a weak number. If this comes in very strong, like above 50, then I'd expect I expect downside to return in gold. So if this comes in above 50, I would be looking at trading gold short, and that would increase expectations for more aggressive Fed, especially if the data point pushes higher on this. If it's just a big miss, that's kind of what's expected. If it was a huge miss, like 45 or lower, and a massive miss, then yeah, okay, you could see a little bit of upside in gold, a little bit of upside in the S&P 500. It is tradable today, right? But only on a very big miss or a very big beat. But the main event is this services PMI 1, because of the the strong strength we saw at the last meeting, which is a bit of a surprise. Okay, folks, I hope that's all okay. Very good to have you here. Kingsley Mihai, Eddie, Thomas, Yannick, good to have seen you. I'll just hold on for any questions. Otherwise, take care and have a very good rest of your afternoon. Thanks, everyone, now. Goodbye. Yeah, that's great. Yeah, you're welcome, Yannick. You're welcome, Mihai. Great, that's all clear. Lovely. Yeah, thanks. Don't forget, back on Monday and back on Wednesday next week, we'll do the same again. Thanks, everyone, now. Goodbye.